Hi class, welcome to lesson number 15 in this continuing course for the AP Micro and Macroeconomics. As usual, it's tradition that we go over the last homework problem, and the last problem that I asked in lesson 14, I believe, was tell me the 3 steps for solving a maximizing utility problem. And let me just write down the first 3 steps that we have to do for any single problem. Now, this is not going to be the guaranteed formula for success on these problems, but it's a good guide to use. Okay, so number 1 that we said was that, and remember this is for the maximizing utility problem. So I'll just write down max utility. Okay. And the first one I believe was, remember the basic formula, right? We said that marginal utility, right, of x, right, x as in product x, okay, over the price of x, right, is equal to the marginal utility, right, of product y over price of y, right? Now we said that these ratios are important because in problems like these, when you have to say, hey, what's the best bundle, right? Try to find me the best bundle for the maximum amount of utility you get out of it. What you want to do is find certain combination of products, right, and find the best utility out of that. So the way we said that we find those combinations, right, those bundles that we said, right, is that we know that the prices are always fixed. The marginal utility for every single item changes, right? If you have 1 slice of pizza versus 2 slices of pizza, the utility changes, correct? But the prices are always the same, okay? At least in the problems you guys are going to get on your AP test. So, if the prices are fixed, right, using these prices, we get a ratio of MUX to MUY or MUI to MUX, right? And that's how you figure out the combination, right? You figure out the combination, right? Or they're also called bundles, right? Now, the second step, right, was to, let me make sure I'm getting this right as well, is to make sure that we're making sure that we're within our income. What do I mean by that? Well, every problem, right, is going to make sure that they give you some sort of income. They say, hey, you, John, right, I'm making up a name right now, okay, John is going to make $50 of income, right? So based on that income, he can buy X and Y. Does that everybody make sense? So it's like, if you have a certain amount of X and you have a certain amount of Y, that cannot go past, right? Cannot go past your budget, right? In our example, it's $50. So you got to make sure you're within your income, okay? So what do I mean by that? From the combinations that you got from the first step, right? What you do is you figure out how much it costs. How much does product X cost? How much does product Y cost? And you make sure you're not past this 50 line, okay? You make sure that you're not past income. 50 is an example here, so make sure it's not just, I'm not telling you a number of 50, okay? I'm just saying you cannot go past your income. 50 is just for the example that I've given. The third part is actually figuring out the utility, right? So we want the max utility. And what do I mean by that? Let me just explain. Let me write this down real quick. Okay, so the question is, what is the max utility that we have, right? So when we figure out these bundles from the first step, what you have to do is you have to compute the total utility from each bundle, okay? Total utility from each bundle, and then you go ahead and calculate and you see which one is the max utility. And that one sort of wins the game, and that will be your answer for the max utility problem, okay? So these are the 3 steps for solving those max utility problems. Hopefully in the later on, when we go on through specific problems and mock AP tests, I'll make sure I go over these problems again. So in the last class in lesson 14, we actually went over a specific problem and we tried to solve through that. Again, just to clarify for students, I'll probably try to hit one more problem, but I really suggest you guys do your problems on your own as well. So everybody would be on the same page that way. Anyways, that being said, that would be the homework, right? So we'll move on to the new stuff that we're going to cover today. Before I move on to the big chapter that we're going to start, which is on firms, okay, I want to get 2 things out of the way, substitution effect and income effect. And both these are really important in microeconomics. Let me first start off by defining substitution effect and income effect, and then we can move on to actually explaining them, okay? So that being said, let's try to write down what substitution effect is. Okay. Exciting stuff here. Substitution effect. All right. Now, substitution effect, let me make sure I get the textbook definition right on the board, okay, is as the price of good A rises, and I'm going to just say an upward arrow. This is rises, okay, goes up, okay. The substitute good, whatever it is, we'll call it substitute good B. The substitute good B becomes more attractive to the consumer, okay? And I'll explain this just in a second. More attractive. And remember, this is to the consumer. And then the second part of that is, and the current demand for good A decreases. Demand for good A decreases. All right. Okay. And when I say current demand, one extra thing I'll write this down is I mean amount demanded. Okay. Amount demanded. Okay. I want to be clear because in one of the classes in the when we first started with microeconomics, I told you guys the difference between amount demanded and demand. So this, when I refer to this, it's actually amount demanded. Okay. So I'm going to read this one more time. It says substitution effect basically states that as the price of a good A increases, right, the substitute good B becomes more attractive to the consumer, and the current amount demanded for the good A decreases. All right. So why does this happen? Okay. It's fairly intuitive, right? So if you think about it. Let's take a pretty regular product that we get every day. Let's talk about milk, okay? So I'm sure a lot of you just buy milk on a daily basis or a weekly basis, whatever it is. Milk is, in most parts of the world, right, it tends to be really elastic. What do I mean by that? Is that there are a lot of people that make milk, okay? There's a lot of different dairies, there are a lot of different companies that make milk, okay? So say that I produce milk in your city, okay? And all of a sudden, I become greedy and I say, I'm going to charge 15% more for milk, okay? So what's that going to do to you is that it's going to say, hey, you know what? You're charging me 15% more. There are a lot of other people, okay, who produce the same product, right, for a cheaper price, okay? And you're going to go to those people, right? Now, a substitute good, it could be, let's talk about hamburger or hot dogs. It's the same concept, right? So if it's a substitute good, it basically says that you guys get the same utility or satisfaction or happiness, same thing, right? You get the same utility out of both the products, right? So what you do is say the cost of hamburgers is going up, right? Let's say hamburgers is good A. Good B, right, the hot dogs, right, will become more attractive to you as a consumer because for the same amount of price as before, you get the same utility, right? So if hamburger is becoming more expensive, you're going to switch over to good B, and the amount demanded for your hamburger is going to decrease. So this is substitution effect. It's extremely important to understand in microeconomics, just because of the fact that when you analyze businesses and pricing and things like that, it really tends to help understand how the pricing of your good will affect the demand, or how the pricing of another good will affect the demand for your current good, okay? So understand this, it's very important. That being said, we're gonna move on to income effect. Income effect is also fairly intuitive. That's what I like about these particular definitions, and because they're fairly intuitive. I'm gonna go ahead and erase this board, okay? Income effect, I'm pretty sure some of you can already guess what it is, but I'm going to go ahead and define it anyways, right? Just to make sure we're okay. All right. Income effect. All right, what's income effect? It says that as the price of good A increases, again, as the price of good A rises or increases, okay? Consumer, or consumers rather, consumers can afford less, right? Fairly intuitive, right? So if your income is fixed, okay, we're assuming income is fixed. And all of these definitions in economics, they always say if all else is constant. The fancy term for that is ceteris paribus, okay? But it basically says that if all else is constant, this is how we define the effect, right? So as the price of a good A rises, consumer can afford less of product A. And in fact, well, let me finish the definition. And then the amount demanded for good A, right? I'm just sorry, good GD, A decreases, okay? Fairly intuitive, right? So if they say that you as a person, right, you make about maybe $20 a day, let's assume, okay? This is some number, all right? Random number, $20. All right, so say good A is, again, let's go back to the old one, say hamburger, right? You eat a hamburger every single day, and it's always been $1, okay? It's been on the value menu, all right? All of a sudden, this guy, McDonald's, whoever it is, become greedy and they say it's $2 all of a sudden, right? You've been always making $10, right? Now, all of a sudden, instead of it being 1/10 of your salary, it's 1/5 of your salary, okay? So what this is saying is that if that price of the good A increases, right, income effect states that, again, all else constant, okay, it states that you can afford less of product A. Again, pretty intuitive, okay? But your amount demanded for good A decreases. You know, this might pop up, these income effect and substitution effect might pop up on a test, multiple choice, whatever it is. I just want to make sure you understand later on in fancier microeconomics, we actually graph the income effect and substitution effect. If I think it's necessary at a later point on, I'll try to draw the graph. But at this point, I think it's more important to understand the definition and the theory behind it. That being said, let's move on to the new topic, right, which is firms. And in microeconomics, it's really important to understand firms because we only talk about firms. If you remember at the beginning when we started to talk about the fundamentals of micro and macroeconomics, I said that microeconomics, if you think about macroeconomics, which discusses the economics of the entire system, right? If you talk about international economies and things like that, if macroeconomics was the forest, microeconomics is the tree. Okay, so firms are really important because in microeconomics we deal with the economics behind these firms. So obviously very important. So that being said, let's start off with firms. And again, basic definition. Let's do definition of firm. Okay. This class especially is going to be very definition heavy. There's going to be a lot of writing on the board. So forgive me if there's a lot of time being spent on the board. But you know, good or bad, I think it's really important to understand the theoretical definition because once we have that theoretical definition down, we can take some time to digest what those words actually mean. Okay, so we'll start off with firms. And so what's a firm, right? What is a firm? All right, firm is defined as the following. It says that it's an organization that employs factors of production, and I hope you remember what those are, right? That employs factors of production. And for those of you who don't remember it, we went over that in the fundamentals part, but it's basically your land, labor, and capital, okay? And the other one, the fourth one, that people typically, don't discuss as much is entrepreneurial ability. Okay, we went over that a little bit, but typically speaking in economics, we talk about land, labor, and capital. Of course, entrepreneurial ability is also important, but not as much. Okay, so factors of production, the employee's factors of production to produce goods or services. Okay. And then the other part is that it hopes to have a profitable sell. So the other part discusses profitability. Because you have to remember that a firm, right, which is an organization, and we discussed this, right, that employs factors of production, land, labor, and capital, right, to produce a good and service, they're producing this, typically speaking, to have profitability, okay? Now, you probably have heard of nonprofit organizations, and that's a different arena, but even them, they're giving you a good and service for a particular reason. Whatever profit can be in terms of money, could be any other service, but basically, a firm's a goal in economics, we say, is to make profit, okay? No firm ever is there to just not make profit, all right? So this is the basic definition of a firm. That being said, what we're going to do is, discuss this term, profitability, in the next step, because really speaking, the kind of profit you think there is that, typically speaking, when we discuss with your friends or whoever it is, when we say profit, right, the concept of profit is actually accounting profit, okay? And what do I mean by that? Let's, again, define these, right? So profit really comes down to two things, okay? So the first one that we talk about is accounting profit. Accounting profit. And profit, guys, okay? Profit, the way I'm gonna normally write, or people normally write, is pi, okay? Pi is normally profit, okay? So accounting profit, generally speaking, is the way they define it is your total revenue, right? Which is the amount of money you make by selling something, okay? Minus, right, your costs. And generally speaking, accounting, right, talks about your explicit costs. And what is that? I'll explain to you in a second. Explicit costs. Okay? So your total revenue minus explicit costs is profit. Okay. What do we mean by total revenue? We said that, okay, total revenue is the amount of items you sell, the quantity of items you sell, okay, times the price that you're selling at. Okay? That's P times Q. That's total revenue. All right. So what are these costs? Typically speaking, these costs are, could be your expenses if you have a factory, for the people that you pay, anything that's explicit. Anytime you have to pay someone directly as a cost to make your product, that's an explicit cost, okay? And that's accounting profit, right? So one of the examples that you say is, hey, you know what, I'm selling newspapers, okay? So you say, well, what's the cost to print those newspapers? What's the cost to employ the people in my factory, right? How many newspapers am I selling at what rate? Subtract each other, and I know my accounting profit, okay? And that's generally what people think about as profit. Economists, the goofy people that we are, we try to think of different items, okay? We try to think of a concept called economic profit, okay? So I'm going to move over there and explain to you guys economic profit, okay? So economic profit is a pretty cool concept. And, as economists, we always like to think of this stuff because of one big concept. So before I jump into what economic profit is, okay, let me discuss with you an important term. The term is opportunity cost. Okay? So what is opportunity cost? So imagine that, you are, for instance, right now, you are looking at this video, okay? And instead of watching this video, you probably could have watched TV. You could have probably studied for another subject. You could have probably done a couple other things, right? You could probably worked, right, and made some money there. The opportunity cost thinks about the fact that, okay, if you, right, let's call you John, okay, if you, John, were doing something else, right, well, how much revenue you could have made? So I'll give you an example. Say, for instance, you, instead of watching this video, right, you could have gone outside and you could have worked at the local company somewhere and you would have made $10 an hour. And if this video was if this video was for an hour, your opportunity cost is $10, because what happened is that you missed out on working at some job you could have worked at and made those $10, right? So opportunity costs, okay, another term that they say is implicit costs, okay? And implicit costs factor in opportunity costs. Now, this is the term implicit costs that we add into economic profit. So the way economic profit works is the first term is exactly the same, okay? It's total revenue, okay? TR stands for total revenue, okay? Minus the same term we talked about before, explicit costs, right? How much did you pay the people? How much did everything cost for you to actually make that thing, right? Explicit cost, right? Now the new term for economic profit we like to think about is we subtract the implicit cost as well, okay? And this is the formula for economic profit, okay? Economic profit is equal to total revenue minus your explicit costs minus your implicit costs, all right? So one of the biggest differences between accounting profit and economic profit is this term of opportunity cost, right? We're always thinking as economists of, hey, you're doing a certain item, you're doing a certain thing right now, but you've let go of something, and what is the cost of letting go of that opportunity, okay? And it's a very cool concept to think about because, you know, it really is true, because if you're doing a particular item, it's not fair to say, hey, what's my cost for manufacturing those papers, and what's my revenue and what's my profit? It's saying, okay, well, my factory is producing newspapers. What if I was producing, what if I was working? I was not, having my own small business. What if I was working by myself for another company? What's the salary I'm giving up, right? So there are costs to think about, implicit costs. It takes a little time to understand this stuff, but if you can just wrap your head around it a little bit more, look at more examples of saying, okay, what am I giving up right now in order to do a certain event? I think this term opportunity cost becomes a lot more relevant. And trust me, in economics, this shows up a lot, even when you talk to economists and things like that. I don't know why you talk to economists, but if it does happen, whatever. So that being said, let's talk about your big time differences. The way in economics, the big, in terms of time periods, is that there's short run economics and there's long run, okay? And short run and long run, both are very different because economic behavior is very much different between short run and long run. So that being said, as usual, I told you guys this particular class is going to be very definition heavy, and I'll define short run and long run, and then we'll discuss both. Again, fairly intuitive concepts, but worth defining. Alrighty. And if you guys don't mind, I'm going to go ahead and erase this part as well so that we have a little more space to work with. Okay. All right. So let's talk about short run versus long run. Okay. And short run versus long run. Short run. Just saving time, I like to use abbreviations a lot. Short run will be SR for this class. Okay. And long run will be obviously LR, but let me write it down so everyone's on the same page as me, okay? All right, so short run versus long run. So let's start off with short run. What is short run, okay? Short run basically is the cost of excuse me, I am sorry. Okay. All right. So the way we differentiate short run and long run, guys, is that it's based on the fact of two other big concepts called variable cost and fixed cost. Okay. So I'll write it down as well, but intuitively, let me explain what variable cost and fixed cost is. Fixed costs, right, discusses the fact that it is a cost for any production of anything, right? It could be, we talked about newspapers before. We said that. We talked about, it could be making lemonade, whatever it is. A fixed cost is always going to be, okay, this is cliche. I'm going to say fixed, but basically what that means is that no matter what happens, right, throughout that period, your costs are not going to change. Okay, something is fixed cost, right? For example, if you're taking this video right now, okay, and we're in this room, the utilities, right? So electricity, the water, right? We pay per month. The rent we pay per month. So in that month, right, we cannot change these things because they're fixed. They're not going to change. No matter how many videos we take in this room or whatever, it's going to be fixed. Variable cost, however, is different because variable cost can be changed, okay? For instance, if we're taking more videos and we're hiring more teachers and things like that, for every other teacher we hire, it's going to cost more, right? So that's variable. Again, I'll put definitions down intuitively. This is how it works. Now, short run is that, what we say is that in short run, at least one production cost, or input, rather, is fixed and cannot be variable. Okay. All other inputs in a short run can be variable, but at least one is in the short run is fixed. Okay. So what do I mean by this? Typically speaking, in economics, when we give you an example, okay, we say that, well, we talked about what are the factors of production. We said land, labor, capital. All right. So say you have a factory, okay, and we're sticking to this whole newspaper example for this lesson. And your factory prints newspapers, okay? So in the short run, typically speaking, okay, your capital is fixed, okay? What do we mean by that? Think about your factory, right? Think about the utilities that go into this factory, okay? But your labor, on the other hand, right? Your labor is the people who are actually printing this thing, can be variable, okay? But capital in the short run is generally fixed, okay? Because you've signed up for an agreement. You've said that, okay, we've built this factory for the next 1 year. We've paid the rent for this. We have a certain amount of machinery in there, okay? We cannot change those things, right? So that will be fixed. But I can definitely change the amount of people in there, all right? I can definitely change other variables, okay? So the point is, in short run, at least one production input is going to be fixed. Generally speaking, in economics, in microeconomics, it's capital. Now, it's not always like that. Don't quote me on it. But generally speaking, examples you're going to see, they're going to be fixed. In the long run, I'm sure you guys can guess, okay? I'm just going to take this SR out, make it L, all right? In the long run, all right, in the long run, all right, the biggest difference is that everything's variable, okay? And to give you the cinematic effect, I'm going to erase all the words, and I'm just going to put variable on it, okay? Because all inputs, okay, all inputs are going to be variable in long run. What does that mean? Well, think about if we talked about newspapers, and we said, hey, if we're producing newspapers, and we discuss a long run time, the next 5 years or whatever, I can change, I can move to a bigger factory, I can move to a bigger machinery, I can change the machines in there, I can do whatever I want, right? So what that says is that in the long run, right, LR is long run, all the inputs are going to be variable, and we can change those inputs, okay? So, I'm going to, this will be the main concepts for this class. I'm going to summarize real quick and then give you guys a homework problem. Again, the homework problem is going to be more theoretical, but the point of this class was to kind of introduce you guys to the concept of firms, okay? And to understand what the basic idea is behind a firm. And then we went over short run and long run, as you can see behind me. And a little before that, we went over the difference between accounting profit and economic profit. And a big term is opportunity cost. So with that being said, we talked about firms, economic profit, accounting profit, short run, long run. I want to ask you guys, what is opportunity cost? Because, I told you guys again and again, it comes up in a lot of times in discussions, or if you move on to college and take economic courses. So what is opportunity cost? Define me opportunity cost. It doesn't have to be a theoretical definition, but intuitively explain me opportunity cost. All right? That being said, I hope to see you guys in the next lesson. Thank you so much for joining me.